thank you, and welcome everyone. It's so exciting to be here today at the National Cafe to have a discussion with my friends and colleagues about Fintech and Fintech regulation. And it's a really timely discussion. There's a lot happening, and we're so excited to see all of you. We're looking forward to a really interactive discussion today, so I'd encourage everyone to jump in with questions and offer your thoughts as we pursue our discussion. My name is Sethi. I am Managing Director of the Stevens Center for Innovation and Finance at the Wharton School. I'm also Senior Director of the Alternative Investments Program at Wharton, which is our private equity venture capital program. And I teach financial regulation at the University of Pennsylvania Law School. And it's so great to be here today with my wonderful colleagues. I'm going to introduce folks briefly, but then everyone's going to say a little bit about themselves and tell all of you a little bit about their own stories so that you have a good sense of what their background is as we proceed today. So I'm here with Jasmin and Sethi. Jasmin, it's great to see you. Thank you so much for joining us. Jasmin is a lawyer, economist, entrepreneur, and thought leader with over a decade of experience in the financial industry. She has demonstrated regulatory expertise in the areas of securities compliance, regulation best interests, derivatives, and a number of other areas. And she advises and angel invests in companies in the asset management and fintech space. Throughout her work, she seeks to promote the financial access, literacy, and empowerment of retail investors. I'm also here today with Graham McConnell. Graham is an entrepreneur with strong passions in finance and technology, especially software development, cybersecurity, and blockchain protocols. After stints at TA Instruments and Savannah Inc., he joined Relay Network, where he served as a product owner, managing priorities for a team of 12 software developers and test engineers. Drawn to finance, he then joined AJO Partners with $25 billion in AUM, a top-tier quantitative investment firm where he oversaw software development. Today, Graham runs all aspects of Nth Round operations, from product development to sales and marketing to customer support. And joining us remotely, we're also excited to have Jonathan Beschen. Jonathan, thank you so much for joining us. Great to see you. Jonathan is Investment Director of IT Investment Group at Ben Franklin, where he serves as the first contact with potential investments. He has a strong instinct for developing relationships with passionate people and finding ways to collaborate on creative ideas. He serves on many local advisory boards and is a familiar face in the local tech startup scene. Before starting at Ben Franklin, John ran local technology consultancy SparkNet Technologies, which developed and invested in cutting-edge technology startups. He's also a founding member of the local economic development nonprofit Liberty Valley Initiative. So that's the background on everyone, but I wanted to give everyone a chance to tell us a bit about their own story because these folks all have such unique stories. And Jasmin, I'm going to start with you. We'd love to hear a little bit about your journey to joining us here today.
Thank you, and thank you all for being here. So as Sarah said, I have an interest in financial access and financial empowerment, and these are very abstract concepts. So I'd just like to give people a little bit about, how this all came about. So as you can all see, I'm a blind South Asian woman. My sister and I are actually both blind, and my parents immigrated from India, and they, didn't know a lot about how to handle having two disabled kids and how to provide for their financial future and all of these things. And my mother early on read an article about a blind psychiatrist. And so she decided that the key to our financial security was to be very, very educated. And so my sister went first. She was 9 years older, and she actually went right here at she went to Wharton undergrad, actually. So Philly alumnus from back then, and then she got a PhD in psychology, and she teaches at Columbia Business School. So the bar was set very high. I was 9 years behind her, and pushed to sort of keep up with my sister. I couldn't let the family down. And so once I was looking at schools and got in, and I got into Harvard, it was sort of a no-brainer for my father had passed by then, but my mother and sister basically decided, well, of course you must go to Harvard, there wasn't else to be considered. And I kind of took my mother's education advice to heart a little too much. And so I ended up getting my undergrad, my law degree, and a PhD in economics all from Harvard. And so I was sort of a masochist for education. And then, you know, I couldn't quite decide what I wanted to do, which is why I got these degrees. And, you know, I tell people throughout my career, I've been a little bit of a maverick. I've done these different things. I've worked as a lawyer, I've done some things as an economist, and have my own business. But the theme of all of my work, from kind of the struggle I saw growing up and experienced and dealt with, has really been about financial access and financial security. And that's really motivated a lot of my work and my interest in the evolving trends. But Fintech is really about that. How do we get more people access to financial assets?
That's great, Jasmin. Thank you so much for sharing your background and your incredible story with us, with other things that you do today. And I'm looking forward to asking more about what you do in the financial inclusion space. So, Graham, I wanted to ask you a little bit, just to tell us a little bit more about your background and your story.
Sure. Yeah, thanks, Sarah. So in stark contrast to Jasmin's background, I did not make it very far from home. I'm from the area, I'm from a little town called Berwyn. And after college, I came back to this area and worked at a startup in Radford and got the stock option package, which at the time was kind of the most exciting thing to me. I was going to be a part owner in this fast-growing startup. And I ended up leaving a year and a half later, realizing then that I didn't really ask any of the questions about kind of what was my worth, and I really didn't know how many shares were outstanding, all of these things. I just at the time was too excited to really ask these kind of questions. I went from there to a public equities firm where I kind of saw the exact opposite, where there are public company employees that get stock option plans. They can turn right around as soon as those options vested and sell them on the open market. And so that was that kind of juxtaposition that kind of led to Nth Round, where we went out and we started talking to capitalists about liquidity and how the private markets is very with liquidity. And our venture capitalists heard that and definitely that resonated with them because they have hundreds of portfolio companies and no liquidity there. So we ended up raising money on this idea that we could create a very private secondary market for private companies. And so we went to market with that for about a year, tried very hard to sell that. Turns out that that's really helpful for the very big pre-IPO companies. I always use SpaceX as an example. They have an urgent need for liquidity. They've got 1,500 shareholders, and they host these quarterly liquidity events for their employees and their investors all participate. Long story short, it was very difficult putting that to market. And so we did a pivot. Luckily, it was not what I would describe as a very big pivot, because part of that platform that we built was an industrial portal so that buyers and sellers have access to the same information. It needs to be a level playing field. That's an SEC requirement, speaking of regulation. And so we had this portal that CFOs were using to distribute financial statements to their shareholders. And it just turned out that we had clients at that point that were saying, yeah, the liquidity platform is nice, but I really like this distribution platform for information on my company. And it's very private, very secure. So that's what we're doing today is investor portals. I mean, some people describe them as data. And it's not just private companies, but also funds as well. So real estate funds, venture capital funds, they have CFOs also, and they report to their investors, and they almost have a higher need for reporting because they're going to go back to those investors for their next fund and tap into them, and hopefully will have created a good enough experience for those investors that they would then reinvest in. So, yeah, that's just a little bit of background about what we're doing.
That's great. That was so interesting. And I know for us as a firm, the whole area around secondary is access to information. The portals that you mentioned is really an area of focus for a lot of folks as alternatives mature. So looking forward to thinking more about that. And Jonathan, thank you again for joining us today. We're so glad to have you remotely, and I wanted to ask if you want to share a little bit more with us about your background.
Sure. So I actually grew up in Annapolis, and I came up here to go to Drexel University. I graduated there, and a couple of friends of mine and I started a tech consultancy. So we essentially started building technology for early stage companies and middle stage companies, basically in the region. And we did that for a number of years and found that for the early stage companies, our services, we did a lot of different cutting edge tech, so that allowed them to disrupt areas of interest in their, particular industries. And as a result, we just got really good at the latest and greatest technologies. We ended up trading equity for, a stake in the company for the services we provided for a number of companies in the region. And over the 10 years I helped startups in the area, we ended up building a pretty nice portfolio. After the 10 years or so, I found that I actually enjoyed the investing part more. And that's when I jumped ship. I sold the company and moved on to Ben Franklin Technology Partners, where I started with the early stage investments, the very smallest and youngest companies, because that was the area I had the most expertise in. Over my time there, I kind of figured out how to do that pretty efficiently. And so talking with our CIO at the time, Scott Nissenbaum, I said, why don't we do a fund? And I had an interest in cryptocurrencies and that sort of technology, basically since the Bitcoin white paper came out, and had been doing that on the side pretty successfully. And he's like, that sounds like an interesting idea. Let's do a fund around crypto. And so we started looking into it and researching it. And Ben Franklin's a state nonprofit, so everything there moves very cautiously and very, mindfully about how it impacts the state and the region, because we are there to help the region in general. And so what we ended up coming up with was the first completely US domiciled, blockchain enabled GPLP fund, which is basically a follow-on fund to the Ben Franklin portfolio. And now I'm the general partner of that fund, as well as the IT investment director at Ben Franklin. So I've kind of moved up the ranks there. And I continue to, invest in the area, both in the early stage and then also in those later growth stage, which is what Go Philly is all about. So that's my basic career background. I've been involved in, fintech since my early days in SparkNet. We would help various companies in the area. We got into blockchain, like I said, very early in the beginning of the process, and kind of evolved along with it. I've been speaking about blockchain for probably about 10 years now, publicly. So I have quite a bit of background in there.
That's great, Jonathan. I hope you held on to your Bitcoin, and I hope you bought it around the time that Satoshi Nakamoto's paper came out, and I just held on to it. So I'm looking forward to asking more about that in the Go Philly Fund. I want to move straight to talking about regulation as one of the key components of our subject here today, because I know that all of us deal with regulation on a daily basis in the work that we are doing, and regulation is known to be rather heavy in the financial services space, and in particular in fintech and in crypto, because it's the intersection of finance and technology. Jasmin, I wanted to direct this first question to you. A lot of folks think of regulation as being onerous, but there can be opportunities with it as well. And things can change rapidly, and it's a complex area where we have a number of different regulators in the US, not only at the federal level, but also at the state level and internationally as well. So I know that you believe that there's opportunities here as well. You want to tell us a little bit about that and what some of those opportunities might be?
Sure. Yeah, I think this is the question that's illustrated well with some examples. I think, there are certain businesses in fintech that have benefited from regulatory, what we call regulatory arbitrage. They're able to be deal with less regulation compliance than some of their competitors and lower their costs. A good example of this is robo advisors. Okay, the automated investing. Do it on your phone, do it in an app. You don't have, you have very limited human contact. It's very hard to get a human being to help you. But they're actually much easier to start up from a regulatory perspective. Fewer licenses and registrations, international registration, about state law. And that's been an interesting trend because you have a lot of them. It started with smaller fintechs that have now become larger companies like Beschen and Wharton, and now the the big banks have added robos. So I think to just tie back to financial inclusion, I think that's actually a trend that's kind of was arbitrage opportunity that's actually led to more financial inclusion. And then another area where I think regulation is opportunity is regulation often creates data. Regulators require data, they ask for data. We're seeing that now moving in that direction for ESG, asking if we're expecting rule proposal from the SEC, they're asking about disclosures relating to ESG. And that's going to bring a lot more data. And there already is a lot of data out there that fintechs are using. They're mining that to come up with ways for people to invest based on those types of variables. But the more regulated, the more standardized the data, the more you can do with it from an automation perspective and actually create opportunities to work with efficiently.
What's exciting, Jasmin, in a world where we have machine learning, artificial intelligence, I'm sure that we're kind of a hustle that's happening now in terms of using data and building new models and building new companies around it.
Yes, I think there's a lot of companies that are making a lot of money with machine learning and AI on ESG data, and I think that's going to, as the demand for that increases, I think that's going to continue. I'll let my co-panelists add to that in terms of their experience.
Well, one thing that I'll quickly add, Jasmin's definitely more of an expert than I am, but we run into ESG with on the fund side. So, many of these large funds are reporting on standards that is one. So, institutional partners association, just lists basically a reporting standard for funds, and they're getting a lot of interest now from investors that like to invest specifically in ESG, but the problem is that there's not really a standard out there for private, at least on the private side for ESG investments. At least that's what I've heard. And in the public markets, it's also kind of the same way. At least that's what I hear is, yes, there are factors you can look into around ESG, but again, it's not very well defined. And in my mind, I relate this a little bit to, I've been reading a little bit about like carbon credit markets and how those are basically being spun up. Very little rules around them. But I guess it's better, better that they start somewhere and figure it out over time. Because I think that, the thing more urgent be that, than understanding or than really standardized ESG market. Because I think a lot of people are going to invest.
Yeah, absolutely. You may know there was actually an announcement today that Chairman Gensler of the SEC is asking staff to look at requiring ESG data in 10K reporting, which would make it a liability issue for public companies. So I think on the public company side, what you mentioned is definitely very timely. And that's quite an interesting thing to think about is if public companies are required to report on ESG data, could they be sued based on what they do and don't report or the quality of that data. And then my understanding is some companies have asked for protection from liability, even if they're required to report in 10 days. So we'll have to see. But I think, as you mentioned, we know that globally there's ESG reporting and that it's most likely coming here to the US as well, on the private equity side and the public equity side. So it'll be interesting to see what happens.
And actually, just to add, you mentioned, Sarah, about the 10K, that's a great point. So one of the clients I work with is Morningstar, and Morningstar benefits greatly when there's more data. That's their business, the data business. And the 10K data, they looked at the 10K. It's a long narrative document. It doesn't look like data. It's not structured. It's not easy to find. So as you have both bigger companies and the smaller fintechs basically taking these narrative documents and turning it into something structured, categorizing these data points into climate risk, how some kind of metric is what startups now have coming up with different ways to measure, whether it's carbon emissions, whether it's some kind of carbon footprint, different sort of measures at climate. Same thing with governance, diversity, how diverse is this company? You can turn these disclosures into a data point, right? And then you've got something that, okay, investors can use, a fund can use, right? They can take those categories and they can actually say, okay, we only want to invest in companies that meet certain diversity limits or that don't have such and such carbon footprint. And you get a lot of innovation out of that. You get indexes sort of fund indexes, funds tracking indexes that are essentially taking existing indexes but removing companies that have certain liability issues or adding companies that have certain focus. So I think this is spurring a lot of innovation.
Yeah, that's a great point, Jasmin. And we'll take it for all our listeners. I agree with you. I also think in addition to those investment strategies, we'll also see sort of the rise of fabulous investors in this space. So going back to sort of our broader theme, regulation and regulation as an opportunity, I wanted to turn to you, Jonathan, to ask you a little bit more about that. And given your background in blockchain and crypto, which is an area that we all know is, the regulation is very murky, and it's definitely the subject of a lot of attention. Of late, there's hearings in Congress on issues ranging from central bank digital currency to cryptocurrency generally. We hear in the news about enforcement actions against companies like Binance or BlockFi in New Jersey, for example. Secretary Yellen convening the president's working group to talk about issues like stablecoins. So these are all sort of live issues in the blockchain and cryptocurrency space. And I would love to ask you, how do you think regulation fits in with that? Is regulation an opportunity? Will clarity be helpful there? Is it good for innovators? Or is it going to add more burden and make it harder for innovators to create value in that space?
Yeah, and I can speak to it from a couple of different points. So from, a blockchain enthusiast standpoint, I personally have been involved for a while. And so I find regulation to be a clarifying event, right? When you get a strong regulatory framework that's clear and understandable, you can act within that framework pretty easily. And that gives a lot of opportunities to grow businesses that are not going to be interfered with, to invest in companies in areas of growth that are valuable for the ecosystem as a whole, and to help the overall ecosystem grow because there is clarity on how it plays out, be it tax wise or regulatory wise. And then from an investor standpoint, we look at the same thing, right? The more clarity there is in a framework or any industry actually that we're investing in, because we do, everything from med tech to fintech to all between. The more clarity there is around a regulatory framework that we have to invest in, the easier it is to invest. It's one less risk factor we have to consider. So for me personally, I'm all for regulation. I like regulation frameworks that aren't, stifling, but are very clarifying and help develop an ecosystem and allow enough room for innovation. And I think they're totally compatible options and ideas.
That's great. And I know you have particular experience in this space, having launched the Go Philly Fund. I would love to ask you a little bit more about that. I know that a few of my listeners would love to know more about just what is the Go Philly Fund, how did you create it, and how was the process of launching it, and then how did regulation fit into that?
Yeah, regulation was a big front end lift, because when we started working on this, and probably, I guess it was around 2018, it was just after the 2017 cryptocurrency ICO craze was going on. So that's where the idea kind of culminated and came from. And then what we saw was that there was a lot of opportunity, a lot of money out there to raise funds and develop companies. And we thought it was a great idea to kind of follow the same idea and trend. Well, what we found is when you're doing a fund separate from an individual company, there's a lot of regulatory compliance that goes into that, especially in the US. And we wanted to offer it so that it could be an option for anyone to invest in globally. So when you're taking investment from a global situation, hence the Global Opportunity Philadelphia Fund, it becomes a bit of a question. How do you do that? How do you take money from all these different countries? And what we found through a painstaking, legal exercise and exploration was that it's not very easy from the US. And I think we are the only, if we aren't the only, we're the first fully regulated or fully US regulated blockchain enabled fund. There are several other funds that have kind of, company presence in the United States, but if you dig into the legal framework, their actual fund is based outside of the US because the current US structure doesn't really allow for secondary trading, doesn't really allow for a lot of the advantages that cryptocurrencies and smart contracts can bring to these type of funds. And, ultimately, most of our LPs ended up, stepping away from the tokenization aspect. And we used a company called Securitize that tokenizes, all sorts of things. And essentially, we tokenized the LP interests and found that because it wasn't really easy to trade, we ended up having to manually handle every single transaction that was going to happen because of US regulations. It became less viable and everyone basically said, no, not for me. And so we ended up converting back into a basically regular fund. And that's one of those situations where, the regulations are unclear and haven't really caught up yet to what the technology can do in the United States. And I think that's a place for us to evolve. And I think we are. It is actually happening right now. You hear about it quite frequently from, the crypto lobby in DC and the like. So we're getting there.
And that's so interesting that you mentioned that because I heard in an interview Tim Draper the other day was saying that he wishes that he had a way to tokenize his next venture fund, but they're still working on it and working on the legal side of the technology. And then the fact that you mentioned Securitize is really interesting because that's a company that we're familiar with at Wharton, and I know they have a strong component or a strong product around as well, which is really attractive to those who are thinking about this same space. I wanted to ask you about this also, Graham. I know you have a lot of experience in this area.
Well, actually, so it's funny you bring up Tim Draper. Tim Draper was the first VC that we went to talk to, and actually he had his son Adam there. And I would especially Adam, I would describe them kind of as fundamentalists when it comes to blockchain. They any idea of regulation, especially back in early 2018 when we spoke to them, any idea of regulation was a big turn-off for them. And I think that's part of the struggle is that there are these fundamentalists that are butting heads with reality, which is, so just as an example, with the blockchain world, when you transfer something, that is an irreversible transfer. It's an immutable record. But the SEC says that if the equity in your company falls to the hands of an arms dealer, that you as a company need to have the right to revoke those shares, basically, tear off those shares, which, if you take this fundamentalist point of view, that's completely at end to that, because, you wouldn't be able to revoke those tokens from that arms dealer. So that was one thing that we had to work really hard to do was, we were basically using a very standard ERC20 token, except that it had these certain modifications in there where there was someone at the company that could actually revoke those tokens. And we said that to the Drapers, and they almost tore our presentation because they just didn't like that idea.
Well, so that's interesting. That kind of leads to my next question. I know that you have done a lot in the space of different protocols and Ethereum in particular, the smart contract. So maybe for those folks who are watching and listening who aren't blockchain geeks like all of us, if you could just tell us, what is a smart contract? What are you doing in that space?
Yeah. So for us, it basically took us out of becoming the middleman or the transaction between two individuals. So we wanted to remain an independent third party and allow for really the website. It's not even an exchange or these listing service amongst their shareholders. So they're trying to bring two parties together that allow them to transact on some equity. And in order to do that, there needs to be a trusted third party to kind of say, okay, you take my money and or I'll take your money and I'll take your shares and I will swap the two. And there's, that kind of takes that risk out of the equation. And so that's really what the blockchain for a smart contract is doing for us, is saying, you're going to deal with me, the smart contract, and I'm going to make sure that both parties, follow up on what they say they're going to do. So, I mean, for us, it was very simple, is that we wanted that third party to be, outsourced and, once more trustworthy and, 200 lines of code that's always going to do the exact same thing. And so the other great benefit is that it runs 24 hours a day. So as opposed to a public stock market where, it's open from 9 to 4:30 or 9 to whatever the time is, blockchains are open 24 hours a day, 7 days a week. So those are the two things that we're really trying to track.
That's interesting. I'm going to write that line down. Your quote, what's more trustworthy than 200 lines of code? I like that. Awesome. So I wanted to return to a larger theme here about regulation. Jasmin, go back to you. You've had so many different experiences with many facets of fintech in your work and as an investor as well. And just talk more broadly again about regulation as an obstacle and opportunity. And you and I were chatting a little bit earlier about some of the potential risks of regulation. That's kind of one of the themes here today is, what could happen in crypto, what could happen if there are more lines of the regulation changes. Can you just, tell us a little bit more about your view there about regulation as a potential obstacle or risk, and how should entrepreneurs deal with that?
Yeah, so I think Graham made a very good point about kind of being realistic about regulation. I think a lot of entrepreneurs think, when they enter a space that's not very regulated, where they start engaging in a practice that's currently not regulated, it's going to stay that way indefinitely. And they see, most people think of regulation as an obstacle to innovation, but as John said, it doesn't have to be. It can provide a lot of clarity. So a couple of examples to kind of make the point, and I think my theme here is think about these risks early, get with lawyers early. So put it with lawyers. Or people who can think about your compliance risks and reputational risks. I think we're all pretty familiar with Robinhood and the GameStop volatility earlier this year. And Robinhood's been a very interesting company. It's been, kind of pushing the envelope a bit on trading. They would argue they've democratized access to investing. They've made it very easy, very accessible to lots of people who weren't trading before, including trading crypto, as well as stocks and ETFs. And so they've gotten a lot of people engaged, and they've made it fun. And it's not, if people take that to a level that maybe goes too far and is too well thought about their own portfolio, that's not necessarily Robinhood's fault. One could argue that, they're a business, they're agnostic to that. But they have been engaging in some practices that have gotten them, some reputational risks over the years, payment workflow, kind of misleading statements about whether certain accounts were government guaranteed. And they had some, let's just say, blood ups. They had some, different times when they basically kind of messed up, drew a lot of attention. And the GameStop situation, it was building for a while. It was kind of all of a sudden they had to manage their own situation, margin calls, and stop trading. And that drew a lot of scrutiny. And a lot of people watching the congressional hearings might say, well, wasn't Robinhood's fault? It was these investors who got together on these other platforms. But you could also say, well, Robinhood kind of had it in for them. They were kind of on the line with a lot of things things for a while, and it was the reputational risk. It wasn't necessarily that it became illegal, but they drew a lot of attention, and now they've got a lot of attention on them from all different directions, from Congress, from it's become a sexy issue on the left, federal regulators, state regulators, and so on. So, I think the lesson there is think about not just where things are today, but where they're going. The same thing, with crypto, as it's becoming more accessible, as it's becoming more people are investing in it now, even in 401k plans. Invest up to 5% of your 401k with some providers in crypto. That's going to get the attention of some regulators. Okay, do we want that? Is there a fiduciary duty issue there? There's some questions. I've seen analysis saying that even just 5% of a standard stock, 60% stock, 40% bond portfolio. You put 5% of that instead in Bitcoin. Okay, that increases your portfolio volatility by 70%. That's a lot, right? And so that does raise questions of, okay, so if you let people invest 5% more, okay, is there a fiduciary duty violation? So, as you do these things and you are cutting edge, it's interesting, it's innovation, but then be prepared to defend it, be prepared to kind of think about the reputational risk, regulatory consequences, and so on.
Yeah, that's so interesting, Jasmin. And knowing that you have particular expertise around fiduciary duty and regulation best interest, I think that for the folks who are joining us today, who are interested in this topic of regulation, I wanted to ask you if you could just talk a little bit about what that means. Like the introduction of a fiduciary rule through the Department of Labor several years ago, and then over the last 4 years, the potential revision of that proposed rule, and sort of where we are now with regulation beyond it. Can you talk a little bit about what is that? What is the fiduciary rule for advisors? And do you think that the rule was improved with the revisions made over the last couple of years, or are we still not quite there yet in terms of putting investors first?
That's a great question. I'm going to try to answer it.
Sorry, it's a lawyer question.
It's a lawyerly question, so I hope people aren't bored by the answer. So I'll try to keep this interesting and not too long, because I can talk about this all day.
Me too.
I'm sure.
We'll have another session.
So
You're coming too.
Many of you, I don't know how many of you follow this, but ERISA lawyers who rarely get acknowledged were really excited because some years ago, I forgot exactly which year, but Obama actually mentioned ERISA in a State of the Union address. And that was a really big deal for ERISA lawyers. No president has ever mentioned ERISA. So the fiduciary rule became this huge political football. It went through many revisions. The Obama administration went through several iterations. Trump administration pulled it back. Then it was put into place at the end, sort of a watered down version. Now they're talking about more amendments. I think the important part as an investor to keep in mind is the advice you get, the investment advice you get depends, first of all, on whether you're getting advice on a retirement account, okay, like a 401k or an IRA, or a 403b if you work on education and so forth. Or whether it's a completely outside, just a brokerage account you're doing on your own, not tax deferred. Okay. So they've got that sort of separation. There is a higher duty, there's a higher standard, okay, when we're talking about retirement accounts. That's where fiduciary duty comes in. The other aspect of this is, are you paying for advice? Okay, are you actually paying someone like an investment advisor? And there's a lot of terms thrown around in the financial industry: financial advisor, investment advisor, broker. There's all these sort of, okay, well, who's actually supposed to do what? And it's not simple. And the SEC has asked for disclosures from firms to explain the differences, but I've been looking at them, they're actually not very good. So they're not written in very plain English. So it's unfortunate. But I think as an investor, you can empower yourself and you can look at, okay, well, you should ask your advisor, well, what is your duty? generally, if you're a registered investment advisor, advising on a retirement account, right? That's sort of the best case. That's basically where you get the best advice. You're paying someone a percentage of your allocation. They have a duty to you. Okay, they're not supposed to get paid to put you in certain products. They're not supposed to put their interests ahead of yours. You can also have a great employer who has a great employer plan and just happens to pick really good funds and products in your plan lineup. They're governed by a risk. Now, not all employers are equal. So some of them, may not follow their duty as well as others. But they are all supposed to follow a certain duty. But if you're just, if you're on your own, you're trading on that Robinhood account, okay, you're self-directed and you're on your own and, there's no one knows you anything, okay, you make your mistakes and that's it. There's no problem. There's no one protected there, no protection there. And if you go to a broker, it used to be if you went to a broker was just a salesperson. They could sell you anything. They could sell you something that makes them money, just like a realtor. And now they have to follow regulation best interest. And that makes things more complicated. They could have conflicts of interest. They're supposed to make you aware of them. They're supposed to do something about that. So if they're getting paid to sell a product, maybe they're supposed to tell you. Maybe they some firms would say they shouldn't get paid based on that. So every firm's doing it differently. We're going to see how the SEC enforces it. I would encourage anyone who is relying on a broker's advice to be cautious and to ask a lot of questions. They do have a higher standard. That's your question. Is it better than before? I think so. But I do think a lot is going to depend on the enforcement, which we're seeing as we get more.
Very well, and I like the plug for lawyers. I think that's always good advice is when in doubt, ask the lawyer. Well, that's great. That's really helpful, Jeff. And I think it's important for all of us to keep in mind as we talk about all these issues that really at the highest level this is invested and different kinds of investors and different types of funds, ranging from retail to institutional to folks who might be accredited investors who have access to the kinds of private accounts that we're talking about today. So along these lines, oh, by the way, I wanted to invite everyone who's watching or who's listening to be sure to ask a question if you have a question, or if you're watching on your computer, to send a question in on the chat. We would love to answer your questions and have this be a really interactive session. So please go ahead and send your questions in if you'd like to ask us something. I'm going to return to something that was mentioned earlier about, in the context of talking about blockchain and crypto, and whether companies are domiciling here in the US or elsewhere. As we think about sort of our broad regulatory framework in the US, this is increasingly become an issue for fintech companies. Because, here in the US, I'm sure all the entrepreneurs who are watching are aware, we have this sort of labyrinth of regulation with all of these federal financial regulators. We have the Fed, we have the FDIC, the OCC, we talked about the Securities Exchange Commission. We haven't mentioned the Commodity Futures Trading Commission, but that's certainly important, especially in the space of futures and cryptocurrency futures, for example. So all of us working in this space and all the entrepreneurs who are thinking about fintech have to deal with regulation. And we often think of it as challenging, but another way of looking at it is to view it as a partnership or a collaborative effort to work with regulators to clarify what the rules are and where the guardrails are, and to grow companies. And in some ways, that's similar to what some other countries do. Now, we're not looking out here in the US to have a sandbox like they might have in the UK or in Singapore, but at the same time, we do have regulators who are motivated to help entrepreneurs grow their companies. So I'm going to ask each of you, and maybe I'll start with you, Jasmin, sort of about this generally. What's your approach to that issue of dealing with regulators, and what advice would you give to the entrepreneurs who are watching today?
The first thing I would say is hire a good lawyer, because I totally agree with that statement. And when we were developing our fund, that's where we started, actually. We hired a local lawyer that had expertise in blockchain and innovative technologies and fintech. And honestly, they do the heavy lift, they do the research, they check what's happened, in cases and things of that nature to make sure that you're walking the right line. So yes, hire a good lawyer, make sure you're doing your research for sure. And then when you're dealing with regulators yourself, as we do with our state-based fund all the time, I mean, they are there as public servants, right? And that's true of all these regulators, SEC, FINRA, et cetera. And, so if you work with them in a way where you're trying to come to mutual understanding and appreciate the same sorts of things, it tends to work out well, because they don't want to be seen as, monsters that are getting in the way of innovation. That's not at all their goal. They're there to actually help keep people safe from X, Y, or Z. And there's a reason they were set up. And so as a result, if you come to them with that in mind, you tend to get a lot more, interesting results and people trying to be creative about how you can work through things. And even, we've even gotten to the point where we've helped with certain lobby efforts specifically to try to change regulation, and it's, it's slowly happening. So I think that's the kind of a mindset you need to go to regulators with, because, any other mindset's not going to get you very far, in my opinion.
How about you, Brian?
Well, I mostly echoing what John has said. Definitely hire a lawyer. That's one of the first things that we did.
It's 3 times you said hire a lawyer.
But I mean, we've had very good experiences with the SEC, and in particular, I'm gonna screw up the name of it, but I think it's the Office of the Small Business Advocate. That's at the SEC, which is a relatively new subdivision of the SEC. And I believe it's Martin Miller that runs that. We had a very pleasant experience connecting with her on multiple occasions, and they're often going out and actually looking for feedback from small business owners on proposed regulation. And you'd be surprised not many people actually come back to them, or at least that's the sense that I got, is that not many people came back to them with comment. And so I don't know whether the effective decisions that they were making, but they were very kind to spend 30 minutes with us and really genuinely hear our concerns. And so I think, in general, the SEC is there to protect investors, and they're doing, they're trying to do what's right for retail investors. And so, we have a lot of respect for the SEC, and I think, in many cases, they're respectful. In all cases,
That's great. And Jasmin, you were at the SEC, so I know you have personal insight into this question as well.
So yes, I've been on both sides. I've been at the SEC working on regulations, and I've been representing clients before the SEC on our banking firms. And so anytime you have a proposed regulation, I don't know if everybody knows this, but you have a notice and comment process. Anyone can comment, even private citizens. You get letters sometimes that are kind of interesting from random individuals. Sometimes people who are in jail all the time. But you also get a lot of, very sophisticated letters from big companies who've had lawyers often write them. And I would say, regulators, I don't SEC, but I think other agencies as well, love data. They love to get letters that give data that support your position, and it is helpful. And I'm glad that Grant had a good experience going into the SEC. And it is often helpful to follow up with a conversation, and they're often happy to do that and to have those conversations to clarify, to ask follow-up questions. So that's definitely good to do, especially if you're working in a cutting edge area and you want to get some clarity. They're not going to tell you what they're going to do. They can't. But sometimes you get a sense from their questions as to what they're concerned about, and that's very helpful. One other point I want to make about regulation, because it is really relevant to crypto, is the area I worry is when you have two agencies regulating the same area, and it would help for them to coordinate, but they often don't do very well. And we saw with the Dodd-Frank Act that the SEC and the CFTC not coordinate very well. they did very different rules in different areas that, arguably there's no reason for such differences. And with crypto, I also worry about the same thing with the cryptos being a commodity in the CFTC jurisdiction, and then with ICOs and funds being ETFs being in the SEC jurisdiction. So I hope that there's better coordination and collaboration, but I'm it's difficult about that.
That's great. And Jonathan, how about you?
Yeah, I just wanted to add on one little bit to that. I totally agree, and that kind of goes back to my point about clarity. When you have two different agencies with different mandates, missions, and reasons for regulating and being careful, basically looking at the same thing from two different lenses, it creates a lot of uncertainty, which means it's very hard to innovate in that space because you don't know how it's going to land and what's going to happen. And on the investor side, that makes it difficult as an investor to invest in that sort of innovation. So that is one of the challenges I think we see in the crypto space. We're slowly getting there for sure. And a lot of crypto companies are moving outside of the US specifically to avoid some of those challenges. So there's a chance for us to catch up, and I hope that we as a country do, so that we can make a better environment for these companies to innovate here in the US, because I think we have a lot of talent within the financial technologies industry here, and it would be great to keep it here.
Absolutely. So we are running out of time, but we would have time for at least one or two questions. I'm not sure if there are any, but we would love to take your questions.
I do not see them in the chat, but I will pass it over to those in the room if you have their hands up.
Thanks so much, Senator. I think, we've seen, problems with public speak and with organizations, regulatory bodies like the Consumer Financial Protection Bureau, going after what state letters can do, and talk about how to be more aggressive. I'd like to get all of your views around what can regulators legally do to prevent overreach on the part of these labs, so that to truly know and protected from various things that might occur financial problem. There was somebody who's suicide, brotherhood, and then there's much more minor things that a lot of these apps do. When you're working with an app, we're not working with a bank that has very clear responsibilities of the relationship that the bank has with you. What can regulators do to give consumers the comfort they have that they are protected and have recourse?
Great, so thank you so much for that question. I'm just going to repeat it and hope that I get it right, but for those who maybe didn't hear it, I think the question is just in the context of more and more investors and consumers using apps and fintech generally, as opposed to going to a bank and working directly with a person, what can the regulators, such as the Consumer Financial Protection Bureau, do to make sure that those consumers are protected? And I will open that up to anybody who wants to comment on it.
Well, I actually don't have a good answer on the solution, but I'll just kind of reiterate, I think where your guys on it. Part of the problem around it, I believe, is that they're really trying to gamify the stock trade. And, it's great that it democratizes finance, but I think the concern there, which you're referring to, is that they've gone too far. There's less barriers for someone to step in and say, here are the actual risks that go along with, trading options, naked options that, if something goes wrong, all of your investment will go on. But I'm not seeing the answer how regulators help with that knowledge. So,
I think you make a good point. And I was going to make a comment about investor protection generally, and Jasmin, I don't know if you agree with me on this, but in law school, when we studied securities regulation, one of the key concepts that we talk about is what is investment advice. And so what I find interesting in gamification of trading is that you'll have thousands of people on websites giving what is essentially investment advice, but predicating it with the phrase, this is not investment advice. And I think that's certainly an area where folks at the Securities Exchange Commission and Consumer Financial Protection Bureau are working hard to put guardrails around, because some things certainly are investment advice, and we have to take the idea of investment advice seriously. And although we want to democratize the financial markets, we also want people to be making sound investment decisions based on real financial principles. So I think that's an area where we'll see increasing focus.
Yeah, and I think that's interesting. I think it's a very challenging area. I mean, I think what you bring up, Sarah, about speech on investment advice, it's so hard to regulate because it is speech, and then where do you draw the line and not allow people to educate? You know, there's investment education, there's opinions, and so forth, and then you have journalists as well writing about this. I mean, how do you draw the line? It's a very difficult area. I mean, I think, unfortunately, I think the deeper problem here is a lack of financial literacy. And I think the longer term solution is really, I think we should have financial literacy in high schools, all over the country. I think it should be part of public high school education. I would be fine with gamifying in high school if it's not real money, let kids practice on apps, let them learn the consequences. Maybe have them, trade something that pencils or something so they can see the consequences of not be losing their parents' money. But I do think there's a sore lack of financial literacy. That's
Are there, I don't know if you wanted to comment, Jonathan, or if there are other questions?
Let's go ahead and take time for if there's any other question. Otherwise, I'll comment.
Maybe one more question.
Maybe one more question. We have time for just one more, so I will pass it over to Rob or
That was also a message to keep questions short. So what Jasmin wrote a very interesting point earlier on about reputational risk and trying to anticipate that in an action it might take. So this question maybe first to you with the rest of the panel. What process might you follow to try and think about potential reputational risk of actions that are ready to implement a new strategy or startup, or even as an existing company looking to go into a new area or launch something new and disruptive?
Yeah, I think you definitely have to use your imagination about worst case scenarios. As depressing as that might be, but I think it is actually really important. And lawyers are often good about thinking about worst case scenarios. Sometimes they can be a little bit too pessimistic. So it's good to get different perspectives. But I do think that one needs to think about what can go wrong in every new technology, and then how you would respond and how you would defend what you did in the context of that. It probably didn't do a very good job of defending themselves. They're pretty bad at it. So, I think they could have done better, and they could have anticipated some of that volatility and thought ahead about, okay, what happens if we have this situation where we have a margin call? Shouldn't we be looking at this earlier and notify people or give people the option not to trade on margin? There's different ways to handle it. Not every firm handles the same way. They clearly weren't looking at what other competitors.
I'll just quickly add, when a new company is creating a business plan or private placement domain, part of that is risk factors. And I wonder whether there's something to be said about maintaining the list of risk factors as the business evolves over time, so that you are envisioning those worst case scenarios.
Yeah, I agree, and just add on to that really quickly. Yeah, absolutely. As an investor, that's one of the main things we're looking at. Are you looking at your own risk factors? Is that something that you actually are monitoring and watching? And if you find yourself at a loss for finding them, ask your investors if you're an invested in company, because they're definitely thinking about the risk factors involved with it, including reputational risks. So, in fact, I think even the GameStop situation came back to some of the investors in Robinhood, kind of stepping in a little bit. So I think that's one of those things where that's where a lot of the thought process for risk comes in. And I think you got to consider it that way.
Great, well, thank you so much. We are unfortunately out of time. I know we could talk for hours, but I would like to thank Venture Cafe for hosting us today, and Graham and Jonathan and Jasmin. It was great to have all of you here today, and great to see all of you, and for all of you watching on your computers. Thank you so much for joining us.